Welcome to Investment Solutions by EDHEC-Risk Intitute. We're going to talk about diversification. Diversification is a fascinating concept. It's a very important form of risk management that we use in constructing portfolios. First of all, we are going to introduce diversification and explain what it means and why we need diversification. Then we are going to talk about the scientific approach to diversification. And finally, we are going to talk about the naive approach to diversification, trying to compare those two approaches in terms of how effective they can be. Okay, so let's start with the reason why we may or may not need diversification. Well, let's think about the problem the following way. Let's assume that one can form reliable return forecasts. In other words, let's assume that one can tell at any point in time when looking at different assets which one will perform the best. Well, in this case, there is no need for diversification. In other words, you should not hold a well-diversified portfolio if you have a good understanding of which asset is going to perform best. What you should do instead is invest all your wealth in the best performing asset. And that's a very concentrated portfolio, no diversification at all. Well, the problem is, obviously, crystal balls hardly exist in the real world. Nobody can, with any degree of accuracy, forecast which assets is going to return the highest performance. So in this context, we have to understand that diversification is useful precisely because we're facing uncertainty. Now, diversification is not a goal per se. No asset owner, individual or institutional investor, should be happy just for holding a well-diversified portfolio. What actually makes them happy, which is the end goal of diversification, is the fact that they might, through diversification, earn the fair reward in exchange for the risks that they are taking. So the end goal is extracting risk premia, harvesting risk premia in the most efficient way. Well, precisely now, turning to scientific diversification, well, that's exactly what scientific diversification is all about, trying to extract risk premia, to harvest risk premia in the most efficient way. To see this, let's take a look at a formal definition of the reward per unit of risk. This reward per unit of risk is often defined in terms of the Sharpe ratio. So if you look at the numbers here, the Sharpe ratio of a portfolio is expected return on the portfolio minus risk-free rate. So on the numerator, you get excess return, which is the risk you're going to enjoy by the return you're going to enjoy by taking risk, dividing by portfolio volatility, which is a measure, a quantitative measure of risk. Now, of course, you can decompose portfolio expected return and portfolio risk using individual security expected return and risk parameters. So the whole challenge in diversification is how to choose the portfolio weights, WI, or the portfolio weights, so that eventually the portfolio Sharpe ratio, which we see here, reaches the highest possible value. That's exactly what scientific diversification is all about. Well, in this context, it is pretty clear to see that the inputs to scientific diversifications are the following. You need a covariance matrix, which is pretty easy to estimate. Well, you know, I'm not exactly saying that it is easy to estimate, but what I mean is we have at our disposal a set of sophisticated statistical techniques that allow us to estimate covariance matrices even when looking at large asset universes with a fair degree of accuracy. And then we get expected return vector, expected returns on individual stocks or individual assets. And these are much harder to estimate. These are very, very noisy estimates. And then you get a vector of 1. So the mathematical expression here gives you the analytical expression for the max Sharpe ratio portfolio. And as we can see, it is straightforward to get the max Sharpe ratio portfolio once you have good estimate for expected returns and good estimate for the covariance matrix. But the problem is we do not have good estimate for expected returns. So what do we do then if we need to maximize Sharpe ratio, which requires us to use expected return estimates, and we have no good expected return estimates at our disposal? Well, there's something else that we can do to understand what proxy we can use for the max Sharpe ratio portfolio. Well, let's take a look at the efficient frontier. So that's the standard efficient frontier analysis. This is the risk-free rate over here, and that's the max Sharpe ratio portfolio, the one that requires expected return estimate. So the next question we can ask is, by looking at this efficient frontier, is there any portfolio on the efficient frontier, the estimation of which does not require expected return estimate? Well, it's actually pretty obvious to see that there's one such portfolio. This portfolio is known as the global minimum variance portfolio. That's the portfolio that you see here. To get to that portfolio, you're just trying to minimize variance with no expected return target, and therefore, you do not need any expected return estimate. So that's good news. We can use the global minimum variance portfolio as a proxy for the max Sharpe ratio portfolio. It's not the max Sharpe ratio portfolio. These two portfolios are two distinct portfolios, but we can use it as a proxy for the max Sharpe ratio portfolio. And the good news is it only requires risk parameter estimates, which, as we said, we can get with a high degree of accuracy. Well, so the next question is, how good a proxy for the max Sharpe ratio portfolio would that global minimum variance portfolio turn out to be? And this is where we get the bad news. Well, the global minimum variance portfolio does not outperform a very simple and extremely naive equally weighted portfolio that does not require the use of any sophisticated statistical technique or optimization technique. So in other words, global minimum variance portfolios are not better than equally weighted portfolios in terms of Sharpe ratios. They are better in terms of volatility. They have a lower volatility, but they do not have a higher Sharpe ratio. Well, there's a very interesting paper by our colleague Ramanupal and a number of co-authors. Very influential paper that has shown that if you test across many models, many data sets, none of these sophisticated implementations of the global minimum variance portfolio outperform consistently equally weighted portfolio in terms of Sharpe ratio. Well, I guess then the next question is, well, maybe an equally weighted portfolio is our best proxy for the max Sharpe ratio portfolio. So maybe we should think about naive diversification as opposed to scientific diversification as a way to construct portfolios. Okay, so what's the goal of naive diversification? Well, naive diversification does not try to extract risk premia in the most efficient way. It doesn't try to maximize the risk-adjusted performance of a portfolio. Well, that's what scientific diversification does. Naive diversification only aims at building well-balanced portfolio. Like an equally weighted portfolio is well-balanced. No asset has a greater importance than the other. Okay, so do we think about equally weighted portfolio as the naive approach to scientific diversification? So that's kind of trying to accomplish what scientific diversification accomplishes, but doing it in a naive way. Is equally weighted portfolio the only way to think about naive diversification? Well, the answer to this question is negative. We have learned recently that it might be extremely useful to think about not only equalizing dollar contributions of assets to a portfolio, but also equalizing risk contributions of assets to a portfolio. And we have reasons to believe that if you have to use a naive approach to diversification, trying to equalize risk contribution, it's called equal risk contribution portfolios, ERC portfolio, also known as risk parity portfolios. We have reasons to believe that these risk parity portfolios are better proxies for max Sharpe ratios portfolios compared to equally weighted portfolios. Well, if you think about diversification in the most simple and, going back to the proverbial definition, remember, it's all about a farmer going to the market, and the farmer brings eggs to the market, and the proverbial wisdom tells the farmer, well, you don't want to hold all the eggs in the same baskets. You want to have many different baskets. Well, it doesn't necessarily mean an equally weighted portfolio. What it means is, in a deep way, that the risk contribution from underlying uncorrelated risk factors should be all equal. That's what it should mean. And taking a close look at diversification eventually leads you to the conclusion that, as opposed to be looking at assets, you may want to look at underlying risk factors that impact these assets. Because even if you allocate equally to assets, either in terms of dollars or in terms of risk contribution, well, if these assets are impacting by common risk factors, well, what matters eventually is what the contribution of these underlying risk factors to the risk of your portfolio. In the end, diversification is much more an art than a science. We are left with competing choices as investment managers when we're trying to implement well-diversified portfolio. On the naive approach, we have to make a choice between an equally weighted portfolio, which is equal dollar allocation, or a risk parity portfolio, which is equal risk allocation from correlated assets, or a factor risk portfolio, which is equal risk contribution from underlying uncorrelated factors. Now, if we switch to scientific diversification, then we've got a choice between max Sharpe ratio portfolio, which requires expected return estimates that are hard to obtain, and a global minimum variance portfolio. So we've got many choices. Well, in the end, we do not necessarily want to think about naive versus scientific diversification as competing one against another. We actually have reasons to believe that naive and scientific diversification work best when combined together. In particular, we have reasons to believe that suitably chosen combination of naive and scientifically diversification techniques would allow investors for a more efficient harvesting of risk premia across and within asset classes. This is an invitation for you to take a closer look at our website, where you will find lots of resources in terms of how to implement diversification and how to harvest risk premia in the most efficient way across and within asset classes. Thanks for your attention.